growth concentration delivered a massive 34 percentage point lead for SPYG until diversification's real advantage became crystal clear in the crash. SPYG crushed it with a 118% three-year return by going all in on growth, while DFUS's diversified approach couldn't keep pace. But here's where it gets interesting. That's diversification's trade-off. DFUS's 84% return feels safer, but you're giving up 34 points of potential upside. In plain English, SPYG picked the fastest lane and left DFUS in the dust. We're talking a 34-point gap over 3 years. Sometimes the aggressive route pays off big. But here's where it gets interesting. 101% over 5 years. That's not luck. That's growth stocks consistently crushing it year after year. Here's where the story takes a turn. DFUS gained 71% over 5 years, but diversification capped its upside, trailing the benchmark by a full 30 points. Let's break this down further. Over 5 years, growth absolutely crushed diversification here. SPYG outperformed DFUS by a massive 30 percentage points. That's not luck. In plain English, over 5 years, SPYG pulled ahead early and never looked back, like a marathon runner setting the pace from mile 1. DFUS stayed consistent, but couldn't catch up to that faster stride. Now for the real question. SPYG's 23% return over 12 months proves growth stocks kept winning, even when the market got choppy recently. Let's dig into the details. DFUS lagged behind by 5 percentage points, delivering just 18%, a meaningful gap even during slower growth periods. Here's where things get revealing. SPYG's dominance is clear, outperforming DFUS by 5, 34, and 30 percentage points across 1, 3, and 5 years respectively. In plain English, SPYG's been crushing it like a power hitter, consistently knocking it out of the park. DFUS, they're getting on base, sure, but they're just not bringing home those runs like SPYG does. But wait, there's more to this story. Higher returns mean nothing if you're taking wild swings to get there. Let's see if SPYG's extra risk was actually worth it. Here's the thing though. SPYG's Sharpe ratio of 1.3 means you're getting solid returns for every unit of risk you're taking on here. Let's take a closer look. DFUS's Sharpe ratio of 1.2 shows it delivered similar risk-adjusted returns, even though absolute gains were lower overall. In plain English, think of Sharpe ratios like report card grades. Both funds earned solid B+ marks for returns per unit of risk. SPYG edged slightly ahead, but we're really splitting hairs here. But that's not the whole picture. When volatility spiked, the risk-adjusted advantage vanished completely. Both funds posted identical Sharpe ratios of 0.6 over 5 years. Let's see how this plays out. SPYG's Sortino ratio of 1.8 shows it delivers solid returns relative to downside risk. You're getting rewarded for the losses you actually face. Here's what really matters. DFUS's Sortino ratio of 1.6 shows it handled downside risk better, though it still couldn't beat absolute performance over 3 years. In plain English, Sortino's like descending stairs. You're only counting the painful steps down, not the easy ones up. SPYG took slightly harder tumbles on those downward steps. But hold on a second. SPYG delivered higher returns, but it also carried higher risk. So when you adjust for volatility, they're surprisingly neck and neck. Let's unpack this a bit. Maximum drawdown shows where portfolios really hurt. Let's see if diversification actually cushioned the blow when markets crashed. Here's the key takeaway. All right, pause the video. Who's your pick? SPYG or DFUS? Drop your vote below. Now let's flip the script. A 33% crash shows you what growth stocks do when markets turn. They fall harder and faster than you'd expect. But there's a catch. DFUS's worst drop was just 25%. That's 8 percentage points better than the comparison. Diversification really cushioned the blow here. Let's get into the weeds here. DFUS lost 25%, while SPYG dropped 33%. That 8-point cushion saved investors thousands when markets crashed hard. In plain English, think of maximum drawdown like a building crumbling. SPYG lost a third of its height, while DFUS lost just a quarter. Both fell hard, but DFUS stayed more structurally intact. But here's where it gets interesting. 504 days to break even. That's a year and a half of watching your portfolio go nowhere. Let's zoom in on this. DFUS bounced back in 439 days. That's 2 months faster than SPYG, though you're still waiting over a year to recover. Both funds kept investors underwater for over a year. SPYG took 504 days to recover. DFUS took 439. Either way, that's painful. In plain English, think of recovery time like a marathon runner stumbling near the finish. SPYG fell earlier at mile 20, taking 16 months to recover. DFUS fell later at mile 22, but bounced back faster in 14 months. Let's break this down further. A 37% loss in 1 year. That's the kind of brutal drawdown that makes most investors panic and sell. Here's where the story takes a turn. DFUS's diversification really shines in downturns, limiting losses to just 18%, while SPYG got crushed with double that damage. Now for the real question. When markets crashed, DFUS lost 18%, while SPYG plummeted 37%. That's nearly half the pain for your portfolio. In plain English, when the storm brewing hit, SPYG's concentrated growth bets got hammered, losing 37% of its value. Meanwhile, DFUS's diversification kept it steadier, dropping just 18%. That's downside protection in action. Here's where things get revealing. 18% volatility means SPYG swings hard month to month, bigger than most funds, so expect wilder rides both ways. Now let's put this in perspective. DFUS's 15% volatility means 3 percentage points less swing. That's a noticeably smoother ride when markets get choppy. But wait, there's more to this story. DFUS's lower volatility means you'll sleep better when markets get choppy. 3 percentage points makes a real psychological difference here. Here's the thing though. SPYG crushed returns at 118% versus DFUS's 84%. But here's the trade-off. It crashed 8% harder at 33% drawdown. Higher returns came with steeper falls when markets tanked. In plain English, think of volatility like a roller coaster ride. SPYG delivered steeper drops with higher climbs, while DFUS offered gentler curves, but still kept you moving through plenty of market motion. Now here's where it gets tricky. Over 5 years, SPYG's volatility jumped to 21%. Longer time frames always capture more market cycles and bigger price swings. But that's not the whole picture. DFUS brings calmer waters with 17% volatility, 4 percentage points smoother than SPYG's bumpier ride over 5 years. Let's see how this plays out. SPYG's concentrated growth bet comes with wild price swings, while DFUS's diversified approach keeps volatility significantly lower across all periods measured. In plain English, here's the stormy ocean analogy. SPYG rode bigger waves with more violent swings over 5 years, while DFUS maintained steadier balance. Same market conditions, different ride quality for your portfolio. Now let's connect the dots. SPYG's best year hit 37%. That's your upside when you're willing to ride out growth's concentrated volatile swings. But hold on a second. DFUS's best year hit 26%. Solid, but diversification means you're trading explosive gains for stability and smoother returns. Let's unpack this a bit. SPYG's best year hit 37%, while DFUS topped out at just 26%. That's the price you pay for downside protection. In plain English, when markets roared, SPYG absolutely dominated with a 37% explosion, while DFUS delivered a solid 26%. Like fireworks, both lit up the sky, but one truly stole the show. Now let's flip the script. Just 217 stocks means bigger swings both ways. You'll ride higher when times are good, crash harder when they're not. But there's a catch. DFUS owns nearly 2,400 stocks. That's 11 times more holdings, spreading your risk across way more companies than most funds. Let's dig into the details. DFUS spreads your bets across 2,400 stocks, while SPYG packs everything into just 217. That's seriously concentrated risk right there. In plain English, think of it like the egg basket analogy. SPYG spreads your money across 217 stocks, while DFUS uses 2,393. More baskets mean if one stock cracks, you're better protected from losses. But here's where it gets interesting. SPYG's got nearly half its portfolio in tech stocks. That massive bet paid off beautifully during the tech boom years. Let's go zoom in on this. DFUS keeps tech at 34%. That's 15 points less than typical indexes, spreading your risk across way more sectors. That 15-point tech gap tells a story. SPYG's 49% tech weight powered its outperformance when tech stocks dominated the market. In plain English, SPYG's got half its portfolio riding on tech. That's a big bet on one sector. DFUS spreads the risk with just a third in tech, keeping the rest diversified across other baskets. Let's break this down further. SPYG's tech-heavy portfolio means it soars when technology leads the market, which is exactly what we've seen over the past 5 years. But wait, there's more to this story. That 49% tech weighting cuts both ways. You're looking at a 33% drawdown and 37% worst year when tech tanks. Now for the real question. DFUS spreads risk across 2,400 holdings with tech at 34%. You'll miss some rocket ships, but dodge catastrophic losses too. In plain English, here's the pizza slice analogy. SPYG's gobbling up half its portfolio from tech alone, while DFUS spreads its appetite across many sectors. One's feasting on a single slice, the other's sampling the whole pie for balance. Here's where things get revealing. At just $4 a year on 10 grand, SPYG's 0.04% expense ratio is basically pocket change for investors. Now let's put this in perspective. DFUS costs a bit more at 0.09% annually. That's $9 per year on every 10,000 you've got invested here. But wait, there's more to this story. A $5 difference won't make or break you. Returns and risk matter way more than chasing pennies on fees here. In plain English, here's the deal with expense ratios. Both funds cost pocket change annually. We're talking maybe $5 difference. Don't let couch change be your deciding factor here. Let's take a closer look. SPYG delivers higher returns but with wild swings, while DFUS offers steadier performance for those who value peace of mind. Now here's where it gets tricky. Your timeline matters most here. SPYG rewards patience and nerves, while DFUS shields you from costly panic moves during crashes. But that's not the whole picture. SPYGs for those chasing maximum growth over a decade, while DFUS offers balanced protection for your 5 to 10-year timeline. In plain English, think of your investing journey like a road trip. SPYG's the fast highway with sharp turns and big thrills, while DFUS takes the scenic route with guardrails protecting you along the way. Here's what really matters, and that's the legal disclaimer. Do your own research before investing, friends. Now let's connect the dots. If you're hungry for more ETF battles, hit subscribe. We'll deliver weekly comparisons that actually cut through the noise.